Let's now look at China. Beijing's new online lending rules are seen as curbs to excessive lending growth by banks with higher exposures. These regulations should see a strengthening of risk controls that will likely include a ban on outsourcing key aspects of controls around online lending. How would this influence mainland banking assets in the medium and long term?
The new rules are more likely to affect smaller banks, we think, such as regional banks and micro lenders rather than the larger rated ones, which proportionately have less exposure to online lending. So overall, it may not have a massive impact on the size and mix of credit in the system over the medium term, but the step is nonetheless positive in terms of prudential supervision, particularly in managing system-wide credit risks and overall leverage. And this move is also pretty consistent with what we've been seeing more often from policymakers in China regarding tighter regulations and enforcement, which is credit positive in our view.
Jonathan, what are your thoughts on the China bank property lending caps that have been imposed to curb concentration risk? Will it be effective in containing systemic financial risk?
China's authorities have a track record of targeting unfavourable trends to eventually address those credit risks. On the other hand, banks may try and shift their mortgage exposure off balance sheet via securitization, albeit that represents a smallish amount of the bank's funding as well. But also bear in mind that while these new rules should curb property loans growth, there's still scope for banks to grow their property exposure.
And finally, Jonathan, to Japan, even prior to the pandemic, the Japanese economy had been subdued by structural headwinds. How do you foresee the operating environment for domestic banks going forward in light of the deep recession in 2020 and a slow recovery in 2021?
Interestingly, Japan is one of those markets in Asia where we see the economic recovery largely failing to recoup the loss of GDP in 2020. And putting some numbers around that, Japan's economy contracted by 4.9% in 2020, but Fitch expects it to expand 3.6% in 2021 before falling back to 1.7% next year. So this doesn't augur well for a banking system which, as you mentioned, has faced structural headwinds for some time, including modest growth, low interest rates, and anemic profitability. In response, the banks may look to further grow offshore, as they've done for several years now, including in emerging markets. In that regard, Japan's mega banks have basically doubled the contributions of overseas markets to their total income in the last 8 years. But the environment in their main Asian markets are also under pressure, and so is their capital accumulation.
Jonathan, thank you so much.
Thank you.
And thank you everyone for watching. For more stories like this, please log on to asiatimesfinancial.com for the best Asia news on markets, economies, and more. I'm Christine Zhou reporting for ATF TV.